morning. I'm Amy Castor. I'm an independent journalist. I've had, here we go. I've had stories in Forbes, CoinDesk, and Bitcoin Magazine. So today we're going to talk about governance and
cryptoeconomics.
Shit.
That was yesterday.
That's what happens when you do 5 panels. That's pretty good. We're talking about, and go out for martinis in the evening, right? So we're going to talk about cryptoeconomics. Cryptoeconomics, well, to me, is about using incentives to play by the rules. But before we get into that, let's give each of our panelists a chance to introduce themselves quickly.
Hey everyone, I'm Chris Dannon from Iterative Capital in New York. We're a large-scale miner and OTC desk.
I'm Chris Berniski. I'm a partner at Placeholder, also based in New York, which invests in decentralized information networks.
My name is Leon. I'm the co-founder of Cryptocurrency Market LLC. We are a YouTube channel teaching people how to invest and trade in cryptocurrencies.
Okay, cool. Oh, that one doesn't work. All right, so cryptoeconomics is kind of like its mechanism design, and which is a field of economics and game theory. It's been around for a long time. Game theory started in 1944, and it's about using incentives to get people to play by the rules. And I guess Vlad Zamfir came out with the word cryptoeconomics. Does anybody want to talk about that history? Actually, before, let's go around and give me your definitions of cryptoeconomics, because I think it's maybe evolved a little bit.
Sure. So I think if we consider economics to be the study of the production and distribution and consumption of goods, the sort of cryptoeconomics that interests me and at our firm are the economics that drive miners to join the network, that drive full node operators to operate a full node even at some cost, and all the other incentives that keep the network together without a coordinator.
So I have a pretty similar definition in mind to what Chris just gave. I think I would generalize it to cryptoeconomics being the incentive mechanisms that coordinate between the supply side and demand side of a crypto network. And they're most commonly thought of as the extrinsic incentives, so value, monetary value based. But I think there are, this is where when you start to bleed into more intrinsic incentives, that can still be part of mechanism design, but it's maybe not strictly cryptoeconomics, and this is why the area is so fuzzy.
So I think cryptoeconomics is, the term was really Satoshi figured out how do you get people to participate in the network to operate this thing called Bitcoin. How do you get the miners to people to run their computers to process the transactions? How do you give value? And how do you fund all of this when there was no funding mechanism? There was no VC or ICO that started Bitcoin. It's in a system that is entirely self-funded, which I think is quite revolutionary because it had never been done before.
Mm-hmm. Oh, good. So one of the things with incentives is it's not easy, right? Can anybody tell me? Can you tell us a little bit about why it's not easy, or an example of what can go wrong?
Well, I think last year was an example of, in large part, what can go wrong. I think that there are many ways to provide the capital resources necessary to allow a supply side to exist in the first place. Mm-hmm. And a supply side needs to exist in the first place to even create the resource that the demand side would then consume. And I think that you mentioned Bitcoin, and Bitcoin was really magical in that it just minted this magic internet money out of thin air, and originally it didn't have a value. It was really once it had a market price where it became valuable to the supply side, and you see that in the hash rate, and the hash rate really kicking off as then the supply siders could calculate their profits from supporting the network. And that monetary policy, and it's a similar one to what Decred has used. Decred's slightly more nuanced, but that invests directly in the productive capital of the network, the productive capital of the supply side. I think what we saw last year, just as an example of something that can go wrong, is we started using this technology as a fundraising mechanism that creates investment capital but doesn't necessarily make it all the way into the productive capital of a network, and so the network never has any utility to begin with. And that's an example of
You're
it going
talking
wrong.
about the ICO boom of
The ICO boom,
2017.
yeah. But I'm sure you guys have examples of.
Well, and that was, too, that was really kicked off because it became very easy for people to create these Ethereum-based ERC-20 tokens, right? I mean, they had a whole crowd-fund mechanism built into Ethereum, right, as a way to get people to use the system. And then what happened, without a lot of regulatory oversight, it just kind of kicked off into these platforms raising millions of dollars. And like you said, it didn't necessarily go back into the system. Is that what you're saying?
Yeah, it just sat on balance sheets.
It just sat on the balance sheets, yeah. So that's one great example.
So I think another challenge, if you consider the original economic miracle of Bitcoin or another permissionless blockchain to be the fact that developers contribute code for free. So the miners, we talk a lot about miners and their incentives, but the miners are running infrastructure that they didn't have to pay to build, which is really fascinating. So I think one of the challenges, to go back to your question, Amy, is how do you keep a project vibrant and interesting and equitable and keep the tone of conversation such that it continues to welcome new developers and it doesn't become kind of cliquey or it doesn't send off a feeling of unwelcomeness to new contributors, because at that point your project velocity starts to slow and you don't have the momentum that you need to keep the network improving and growing. It won't do well in any kind of stasis. It needs to be constantly improved.
Chris, I didn't quite follow that.
Sure.
You were saying that it's what is used to incent people to do what?
So the reason that, actually I can go back to an MIT study that I cited yesterday from 2005 about the motivations for open source contributions. And people, when surveyed, generally say that they contribute to open source software because they enjoy self-directed learning. They want to teach themselves some new skill. They don't want to have a boss assign them a project to do it. They want to kind of do it on their own terms. So if that kind of spontaneity is lost in a group of core developers, it's going to be hard to get
What is the incentive? What is it? Is it a token? Is it the mining reward? Or,
No, I'm saying
what?
the incentive to contribute code is the satisfaction of learning and contributing code, according to an MIT study in 2007.
Okay.
2005.
Well, that's really, no, I've not heard that before, where it's just like, this makes me happy, I'm
So,
going to do it.
I think you can break it down into there are extrinsic incentives and
Yeah.
there are intrinsic motivators.
Right.
Right. And generally the intrinsic motivators, even though we fixate on the money, we fixate on the value.
Right.
As Chris is pointing out, the intrinsic motivators tend to be more powerful. But I think that you still need to put food on the table. Right. And this is just bringing to sort of comparing and contrasting Bitcoin to Decred. I think both Bitcoin developers and Decred developers get the intrinsic motivation to contribute to a system that they really care about, right, and that they want to bring to the world. I think that Decred has also taken care of the extrinsic incentive as well of helping put food on the table.
Right.
Bitcoin has found other ways to do that, but they're kind of workarounds because they weren't built into the protocol, whereas Decred designed for it for the developers as one of the supply-siders from day one.
Right. So just to go back to this point of, I live in Cambridge, Massachusetts, and that's where Silvio Macaulay is, and he created Algorand, right? He spent a lot of time working on mechanism design, 7 years in addition to cryptography, and he had always told me that you have to be very, very careful when you build incentives in a system because you can never anticipate what's going to happen. And he would point to that example of Bitcoin mining, of it going, now it's become, can you tell us about that, Leon?
Well, I was going to give an example
Okay,
of
give an example.
the original question. Because I was thinking about it as they were speaking. But
Right.
I think a great example of incentives gone wrong is the DAO. The original DAO, I think that was back in, sorry, my phone went off. The original DAO that happened in, I believe it was 2016 is when
it that long
was
ago?
the DAO. Yeah, I think it's been 2016. But there was this dream of building this incentive structure where it would be, Slockit was running that ICO, and their idea was we're going to create this economic system around these smart locks was the time that they were pitching to investors, and where people could then do do Airbnb, for example, or rent out their bicycles by distributing these smart locks, and you would just walk up to this lock and pay it with ethers, and then the profits would then just be distributed to all the DAO holders. They raised a huge amount of money. Like at the time, it was like 20% of all the ethers that existed.
150 million.
Yeah, I mean, we've already blown past that today, but at the time it was larger than it had. The largest ICO, but
did it go wrong because
it went really wrong because it was the code. But when you create a pile of money that large, the incentive is to hack it, right? I mean,
a new incentive.
So you wanted to, you were saying like, what happens when incentives go wrong? Well, one of the things that could go wrong is you could inadvertently create an incentive that you didn't want, which was, which was a hacker, and there was going to be mistakes in the code. Even today, Ether smart contracts get hacked all the time, and you just created this gigantic pile of money for somebody to come and steal it.
What do you guys think? Do incentives take on a life of their own and create new incentives, or?
Well, I think if you're talking about an international community of software developers, it's going to be very difficult to predict how incentives strike people in different geographies. So I think one of the things that I'm always struck by when we travel to China is how differently they view the crypto game as compared to American investors. And that has to do a lot with their laws and the way they're enforced, or if they are enforced. So for example, market making, what they call market making, as a form of manipulating the price of a token is a pretty common practice in China, and it's common in other offshore exchanges too. Generally speaking, I haven't met a lot of American funds that engage in this because there are serious repercussions here. So, I think one of the ways that, to get back to your question, one of the ways that incentives can go wrong is for people to assume that folks in other geographies are going to react the same way that they do, or are hemmed in by the same restrictions.
And we could go back to Bitcoin mining on that, and how it's all kind of centered in China and places that are like cold, right?
Yes.
Or they have free electricity.
Or they have free electricity.
Yeah.
I mean, when you're constructing these systems, initially it comes down to how profitable is it to run a supply-side agent, or whatever it may be, supply-side machine. So I just saw David Vorik walk in, who gave a great presentation on Saya yesterday. And I think Saya, this is a good example of when you have a lot of supply, the market can offer something at cheaper than, say, AWS can. So Saya is provisioning cloud storage at 1/10 the cost of AWS because they have a lot of supply. And I think, that's a natural system where there will more and more demand will come online until there's really this equilibrium price, which is hopefully beneath that of AWS. But I think if you don't set up the system in the first place to allow the supply side to come on board, then everything will remain static. And for me, it really comes down to having a time-consistent monetary policy that is minting out this asset over time, such that economic agents can say, okay, this is how much money I will make from supporting this network. Let me spin up a node, or contribute work, or whatever it may be specific to that network. If this is profitable and this is something that works, then I'll go tell my friends. And they go and tell their friends, and their friends tell their friends. And so this is how I think supply sides kind of grow exponentially. If we look at, for example, Bitcoin's hash rate, there are also architecture upgrades that have contributed to that over time. But I think a lot of ICOs that we saw are just projects sort of forgot about the importance of a time-consistent monetary policy. And so they have these static economies that never really jump-started. And so they're not going to have demand sides because they never had a supply side to begin with.
They're not going to... Let me ask you guys this. Who should be designing these incredibly complex systems? wants to take that one on?
Well, I think.
Who should be doing this? Is this?
Well, clearly it's the developers, right? It's the people who are writing the code, and increasingly we are seeing economists come on board to work with the developer teams. At Placeholder, this is a large part of what we work on, helping the teams through their crypto economics, and it's really just having been in the space for 4 years now and looking at the swath of experiments, some of which have worked, the majority of which have not worked, and applying things that we've seen work to other networks. I think generally, if we go back to monetary policy, these systems as asset-based systems as opposed to liability-based systems, the monetarists and sort of the skill sets or the types of economists that we used to have that specialize in this are, mostly dead at this point, or not
Really?
not dead, but they're not actively involved in crypto, right? Because the last 50 years have really been, since we went off the gold standard, an experiment in liability-based monies, or money as someone else's liability. And so I think we need a new bumper crop of economists that specialize in asset-based economies.
Right.
To
So
come
what you're
back on
saying is,
board.
there's not
They're being
enough-
educated,
Yeah.
there's- Yeah.
Yeah, I'd like to agree with that, because the current economic system we're all in is based on debt. Every single dollar that is in our pocket, there is a corresponding dollar of debt somewhere else. So if in order for the $100 to be issued, usually it's the Federal Reserve that then, the U.S. Treasury issues, say, U.S. Treasury bills, which then the Federal Reserve buys those Treasury bills with these Federal Reserve notes that they created out of thin air, which then get deposited in a bank.
How does this relate back to incentives?
Well, because I'm agreeing with him is
Okay.
that what Bitcoin has done is, rather than using a debt-based system, we're now issuing a system of credits, right? Similar to, for example, under the gold standard, you go out, you dig up some gold,
Right, but what's
money
the-
is issued.
I guess I'm not following.
So-
What's the incentive, and what are we trying to get people to do?
Well, the incentive, the new incentive before in the current system is you always had to pay back the debt, right? Because these debts carry interest rates. So now we have an asset-based system where there's an incentive to grow the value of that asset rather than to just keep on paying back
Okay,
debt,
so the
right?
mining or what?
I think it's a different. What we're doing is creating and I'm just seconding his opinion that we are now moving. Bitcoin's crypto economics is based on a credit system rather than a debt system. In that way.
Because the credit is when we...
Well, the credit is how we fund all these other incentives, right? Like you do mining, you are issued a credit known as Bitcoin that's really just created out of thin air rather than having to borrow money into existence.
Okay.
Am I not?
Don't quite follow that. But
Okay, all right.
but maybe somebody else can explain it to me.
So just one more comment on the question of who should design these systems. I think
Yeah.
it's noteworthy that Bitcoin's monetary policy is so simple and so predictable and so automated. I mean, if you're a central banker, you should be insulted, right? It's this easy to automate somebody like Christine Lagarde or whomever. So I think. Who should design these systems? Probably more on the software engineering side, on the product architecture side.
Now, are you sure about that, Chris? I'm not, because if you look at the mining,
Yeah.
I mean, who could have anticipated that it would all be, Bitmain doing all this, 50% of the hash power? Is that really what Satoshi wanted when he wanted to design a decentralized system?
Well, I can't speak for Satoshi, but I think if you had shown...
I mean, do you think that worked out well?
I think if you had shown the design of Bitcoin to somebody in the semiconductor industry, they would say, yeah, SHA-256 is pretty easy to build an ASIC for. At what point, how expensive, or at what price does Bitcoin need to reach to make this economical?
But do you think that worked out well? I mean, with the mining situation now, because I know I can't afford to mine Bitcoin. Wouldn't make any sense for me.
But there are other networks starting now that you could
system.
start to mine, right?
Yeah.
You could mine other networks, and like Chris said earlier, they're all exchangeable for Bitcoin. So if you don't want to undertake the risk of mining Bitcoin, you could mine something that's has less hash power on the network, and you can turn it to Bitcoin.
But I want to mine Bitcoin. but
So I think with Bitcoin, we have a really fascinating experiment of a money that is going to adhere to a supply rule. And I think the supply rule of Bitcoin is the most important aspect of it that will the core devs will never deviate from. Mm-hmm. And so that's going to be a fascinating experiment. And we have all these other different kinds of experiments sprouting up, right? So Monero, for example, will have this infinite small rate of inflation. And what it comes to for Decred over the long term, the stakeholders will decide. Right now it's fixed in the way Bitcoin will be fixed. But we have all of these they're really monetary and fiscal policy experiments because they're in these asset-based systems, which we're going to get the majority of them wrong, right? And people are going to learn, but I think we will end up converging upon models that work in specific use cases and are pretty replicable.
Right.
And so we're not even
trial and error is what you're saying.
Trial and error.
We're learning as we go.
But
and I'm going to switch topics just a bit now. Are you ready? We touched on mining, but there's a lot of projects now that are trying to design proof-of-stake systems where it's no longer the miners that are making these decisions or they have so much control over the network, but the coin holders will be able to make decisions on upgrades, whatever. But who is designing these proof-of-stake systems? Or
I think we're in a giant experiment. What crypto has allowed us is it allows anyone who can code to design their own economic model and see what actually happens. So we have thousands of coins out there, and many of them are trying all sorts of different things. And I think one of the strengths of what crypto has allowed us to do is if you have an idea, you can go out and either you code it or you hire other developers to code it, and you can try it out and see if that works or not. And that hasn't been possible really on a large scale before crypto, because it really is basically you're running an it's a giant computer simulation that you're able to run in the real world over and over again until we find something that works. So we're going to have a lot of failures, but I think that that's going to be part of the growing process to find out eventually what works at scale.
Right. And
So,
we don't really know yet what works at scale because a lot of these systems haven't scaled yet.
But with proof of stake in particular, and I'll be curious to hear Chris's opinion as well, because they run some pretty large-scale mining operations, which are not proof of stake, but proof of work. Do you guys do any proof of stake?
We stake our Decred.
Okay, well, there you go. So I think there are certainly different flavors of proof of stake, right? There's something like Decred where it's hybrid proof of work, proof of stake. There's the delegated proof of stake systems. There's the more pure play proof of stake systems. Generally, the people designing these, if you look at something like Ouroboros, they're academics, right? You have to formally prove that these things work. And in the case of Casper, for example, we haven't seen formal proofs yet. And so we're still waiting for those formal proofs. And generally with proof of stake, highly contentious topic in the crypto industry, you require more assumptions about the system in order to allow consensus to work. Whereas with proof of work...
Really?
Yeah.
Is that true? I mean, I don't know.
There are more network constraints, I would say.
Okay.
But feel free to disagree with me. Whereas proof of work is more robust. You need fewer assumptions in order to achieve consensus and consistently arrive at consensus. And so I think with proof of stake, you're still in a very heavy R&D stage. People much smarter than myself that are formal mathematicians and going through and creating these proofs. I talk to some of them, they say this will never work. I talk to others that are equally smart that say, we're making progress. And so I think that it's going to be a bit of trial and error. We're going to put out these different stake-based systems. Some of them are going to blow up fantastically. Other ones may work very well.
So I think of pure proof of stake as sort of an accessibility problem. If you consider that a truly permissionless network, anyone can join it anywhere on Earth, and they can use their own wits to look at the network and see, is what's going on here a legitimate phenomenon, or is there some kind of trick? I think with a proof of stake system where you're not relying on a large amount of hash power to create blocks, to process blocks, you're essentially, I would think in that context, if you're going to devote any resources to that system, you'd want to have a few long talks with the people that created it, because there could be something hidden in there that gives them some kind of preferential treatment, and it would be very difficult for you, having not written that code and maybe not done any formal mathematics, to know that that's in there. So the nice thing about proof of work is that you can look at the network hash power, you can not trust, but you can at least verify that what is happening, what appears to be happening on the network is actually happening on the network. So I'm not saying that pure proof of stake systems won't succeed, but I think they'll be pseudo-permissioned, where you'll need to have some trust in the group that developed the consensus algorithm that it is an honest consensus. And so I just don't think it stands very well on its own. I also want to go back to an earlier point that was made about how anybody can try to pop up one of these systems, and maybe even, I think you said, pay developers to try to build one of these systems. So I think as soon as you pay your developers, you're inserting a sort of premium on your network that is going to have to be paid by somebody, either the miners or the participants or whomever. In a system like Bitcoin or Decred, where people join the network for free, they contribute code for free, I think you're getting about as cheap a network as you can possibly get. I mean, the economics on top of that, you can add a margin, and still Bitcoin transactions are very cheap. So I would say those are the two primary issues that I look at with proof of stake: accessibility and the added cost.
We're going to move to Q&A in a minute, sorry.
Okay,
But
so
go ahead,
I think there's one thing we have to realize is there's two really goals of whether it's proof of work or proof of stake. One is decentralization, right? And one of the problems you've mentioned up is Bitcoin is not decentralized anymore because all the mining's in China, right? Because of the economics there. But the other point we are trying to achieve with cryptocurrencies are censorship resistance, right? That anybody can participate in the network, and having censorship resistance requires anonymity, right? The reason you can't be censored, on a Bitcoin transaction is because we don't know who anyone is. Like, who would you censor? Whether it's a miner or, I mean, we believe the mining is happening in China, but can we really prove it? You can't. You see all this hash power coming into the network, but you don't really know who's doing it or like who the participants are. So you can't really argue you have decentralization. But in order to have decentralization, you need identity. But as soon as you have identity, you know who the people are, then you lose censorship resistance.
Tell me what the incentive is you're talking about.
The incentive. Well, the incentive here is we have two goals we're trying to incentivize in crypto. One is decentralization,
right,
and the other is censorship
resistance.
We're trying to
get people.
So we're trying to balance these two. We're trying to create incentives to balance these two goals. And and James D'Angelo, he did a speech on a talk on this about how it's really he argues it's impossible to have decentralization without having identity, but to have censorship resistance, you also need to be anonymous.
Right.
Yeah.
So that's interesting. So you're making a comment that we do want to bring more people into a network. I thought Christianen's top comment that proof of stake is centralized because you have to trust the people that are designing the proof of stake system.
Not centralized, but more permission.
More permission. So anyhow, you guys can challenge them now. Does anybody have any questions? Oh, we need a microphone. Here, we've got, no, here.
So a lot of crypto assets are like EOS and gold and Monero. Well, gold's not a crypto asset, but they're inflationary. And that's how, they gain more, encourage people to spend those types of things. And Bitcoin is inflationary for a time being, but at some point, it's going to be deflationary. We're only going to have so many of these things. That's a really far way off. But what do you think happens to the crypto economics at the next halving of rewards? Because we have so much money going into miners.
That's a really good question.
And all of a sudden, those rewards get
That's a really good question.
Yeah. So the halving is an very important phenomenon within Bitcoin and lots of systems that have these mathematically metered monetary policies. And if we look back in time, they've had significant impacts on Bitcoin's price. People can debate on, if you really can attribute it to the halving, and maybe the impact of the halving is decreasing over time as Bitcoin is increasingly disinflationary. But if we go back to the first halving, I think it was November of 2012, the next year, 2013, Bitcoin went 60x, trough to peak. The second halving was July of 2016. And in 2017, the year that followed, Bitcoin went 20x, trough to peak. And you can see it from a few different angles. From one angle, it's a supply shock, right? So in 2016, we went from a rate of supply inflation that was 8% to a rate of supply inflation that was roughly 4%, which, as you pointed out, it makes the Fed look embarrassing in a way, because here we are modulating around 25 basis points at a time, and Bitcoin just dropped the supply inflation rate by 400 basis points, and it's kind of like, oh my God.
So you're saying, go ahead.
So there's that side. If you continue to have demand going up and to the right, but you have less and less supply, then that should lead to an appreciating asset. My partner Joel has also pointed out that if you have a static or growing base of miners, but if you just assume the costs to mine are the same, but you cut in half the amount of Bitcoin that's produced, the cost to produce each Bitcoin actually doubles. And so then that is also reflected in the market rate. So I think the halvings are super important events. I think longer term, this disinflationary going on deflationary supply curve, as fascinating as it is a pretty strong disincentive to spend. And the psychological burden of spending such an asset that is set up to be such a good store of value. So we'll have to confront that as time goes on. I don't believe in everything being a deflationary asset. I think it would grind our credit systems to a halt. Now, we can debate on whether credit systems are a good thing or a bad thing. I think they're necessary, and so it's a complicated space, and I guess the only thing I can say right now is it's working, but we're going to have to continually revisit whether these supply curves make sense for their use cases.
It is wicked complicated. What happens, though? I mean, the halving doesn't matter. It's maybe 2020 was when it halves again, right?
Summer of 2020.
12.5 now, and then it'll be half of that, which is
6.25.
6.25. Thank you. So, I mean, it's all right if Bitcoin keeps going up in value, but what happens if Bitcoin were to plummet in value? And then you get half of that.
You would basically have a less secure network.
Right, because what you're saying is not as many miners would be incented to participate in
until
the
you
system.
hit a new equilibrium, right, where there's a lower hash rate, and I am suddenly at break even again because of the rewards that I'm getting proportionally from the network.
Does anybody else want to comment on that, or do we have another question? Well, come on up.
That's all right.
Oh, I'm sorry. Chris, did you want to say
No,
something?
I think that was a really succinct comment. The only thing I would add is, if to your last point, Amy, if the price of Bitcoin did drop significantly, you'd see a bunch of old machines turn back on, because it wouldn't be economical to produce new batches of machines.
Okay.
The upfront cost of producing a new generation of machines is pretty significant. So I don't think it would be a complete disaster. I don't know what would happen, but I think you wouldn't necessarily see, an apocalypse.
Right. Good point. Oh,
Sorry. I think a lot of this will be priced in, because all of these, markets markets do basically price in all of this information. So, the market knows the halving is coming. The market knows, what the price is, and the participants in the markets know this information. So, the halving, my view is that a lot of these issues, as long as the economics and the model is known, then the market price will reflect that. So I don't think there's going to be like this huge apocalypse either, because we all know the halving is coming, and we all know when it's going to happen. And so everyone participating in it will take appropriate act. We can plan for these things, and the participants in this system will anticipate that, because they already know when it's going to happen.
Last thing, and then we can move on. I think theoretically, I agree, but empirically, we haven't seen it, right? Because I remember, if we go back in time, there were a lot of newspaper articles in 2016 around the halving and what's it going to do, and it was kind of a non-event, right?
Yeah.
For 2016, and kind of the same thing for late 2012. And so I think maybe it points to the Bitcoin markets not being perfectly efficient yet. and that maybe we give.
Well, maybe that's an indication that it was known because there was no reaction. The price at the time already reflected that information.
But the following year, we have these.
But we can't say for sure that was because of the halving. It could have been.
We can't.
Yeah, it could have been anything, right? It could have been something else. It could have been, VCs coming in or institutional money deciding to come in and had nothing to do with the halving.
I think we'll find out in 2021.
Sure.
That'll be a third proof point, or it'll, an N of 2 is not enough to prove anything. I agree.
Ready for another question?
Yes, hi. All right, so I'm from a group called Crypto IQ, and I've got people coming to me going, why is the price of Bitcoin just standing still?
The new stablecoin.
Right, the new stablecoin. So a couple questions on incentives. So true or false, if the Bitcoin hash rate and the Ethereum hash rate starts falling, does that give miners the incentive to sell more and more or faster and faster?
Say that again. If
the Bitcoin or Ethereum hash rate starts falling, does that give miners the incentive to sell faster and faster? Does it bring in sellers?
I'm tempted to say yes, but in practice, that's not what I've seen. In practice, we've seen the largest scale miners hold back the rewards and liquidate very little, if anything. So I would say that even though it seems intuitive that miners would want to get rid of their rewards right away, it's just not the practice. And that's not just with Decred, that includes in Bitcoin. So I think that I think that miners have their own understanding of the network, which probably differs a little bit from the way that retail investors certainly, and probably even the core developers, see things. I think that they're looking at the amount of energy and computational power that is needed to produce these blocks every 10 minutes is continually growing. And they're going to do everything they can to continue to require more computing power to produce blocks into the future. Because that actually, I think, is the true value of the chain, is that you're meeting a higher and higher threshold of computing power every block. So that's a kind of verbose way of saying that I think miners are very, very long-term thinkers, And generally speaking, the ones that succeed have covered their asses enough that they're pretty well protected, even if the price of the asset they're mining drops significantly. They've either financed the production of their machines, or they have some other way of making money, like manufacturing machines. This is why we see manufacturers so successful at mining, because they're kind of using retail buyers to subsidize their own operations and reduce their own risk. It's very risky to produce a batch of miners. If you get a bunch of retail folks to come in and help you, you're really doing yourself a big favor. So to get back to your question, I think it would seem like miners would start dumping if the price continues to reduce, but I think in practice you won't see that happen. I think that the people who are dumping are people who bought the coin in a retail context and just don't want it anymore.
Personally, I think that price is what drives hash rate, not hash rate driving price. And the reason I say this is because we can see this in the altcoin market, right? When a coin just spikes up, then all the hashing power gets directed at it, and then when the price crashes, then all the mining power leaves. And that's something a lot of coins had to deal with because their difficulty algorithm didn't adjust fast enough to the market price. So I think the question, I think that miners respond to price, they don't determine the price. They look at the price and they decide, am I going to mine this or am I going to go mine something else?
So hash rate is a lagging indicator, not a leading one.
Yeah. From what I've seen, hash rates is a lagging indicator. It goes up after the price goes up, because then all of a sudden they're going to get a lot more money for mining this coin. And then when the price crashes, they say, well, let me point my GPUs or my ASICs at something else.
So I think that's not right. I think it may be a phenomenon that you see in altcoins because people mine altcoins speculatively, and they're using GPU farms, which can be pointed at any number of chains. But what are those folks really doing? They're just trying to get their hands on more Bitcoin. So I think you have to look at Bitcoin miners And I think it's self-evident that people were mining the network before Bitcoin was trading or had any liquidity or any value. So there is a speculative element that miners, it is speculative, but it's increasingly less speculative as time goes on. It's more and more of a sure thing.
Okay, but what about the case of like Bitcoin versus Bitcoin Cash? If I'm a Bitcoin miner, right, I can mine either Bitcoin or Bitcoin Cash. And if Bitcoin Cash spikes up in price, I'll point my ASICs and mine Bitcoin Cash. If Bitcoin goes up,
but they haven't done that. That's not.
But they could, right? They could. I mean, rationally, if I'm a miner and I'm just a profit maximizing entity, which then, I mean, I have these. I can mine Bitcoin, Bitcoin Cash, or any other SHA-256 coin. I can just, I'm going to point. I mean, if I were a miner, I would just point my hardware at what is most profitable. So I'm actually reacting to the price. I'm not.
So this is an interesting hypothetical, but I'm telling you it's not what happens in the marketplace.
But it could. I mean, I think, but it could. Next question.
Okay, let's try this. I don't know, is anyone familiar with Hedera Hashgraph? Okay, so my question is, do you see Bitcoin working side by side with Hashgraph, or do you see Hashgraph perhaps being more efficient, and because it works with the AFBT, the asynchronous Byzantine fault tolerance, and they can do like 1 million transactions a second or something, and yeah.
Right. So Hedera is Hashgraph's public blockchain, and they have, I believe it's a DAG, directed acyclic graph, and they've put out very impressive stats on transactions per second and a number of things. And we've seen a lot of projects, sort of the next generation Ethereum's, put out really impressive stats in a lab environment, and I think we have to see what those networks operate like at scale in the wild, because it gets meaningfully more difficult. I think with things like Hedera or Cardano or Dfinity or Algorand, I think lots of these things, if they get real traction, will end up interoperating, right? We have things like Polkadot, we have things like Cosmos, to allow cross-chain transfer of value, and therefore maybe you can store your value on one asset but transfer it to or store your value on one chain but transfer it to another chain to garner that chain's utility. It's all kind of a very murky crypto asset soup future, which I think it's too early to say how that all plays out. But I think I fall in the camp of there will be relatively fewer chains that capture massive amounts of value. And while these other chains, more performant chains, may provide a lot of utility, if they don't have monetary policies or they don't have mechanisms that attract people to store their wealth there, then they will have a relatively smaller amount of value.
Ready for the next question?
Thank you. So my question is around the concentration of coins and wallets. So on a lot of coins, Bitcoin in particular, the number of amount of coins is about 50% are in the top 1,000 wallets. And in altcoins, especially pre-mined coins, it might even be significantly larger than that, with 80 or 90% of the coins in a small number, a handful number of wallets. How do you think that impacts the incentive systems, the economics, that like concentration of wealth? Thank you.
I think the concentration of wealth is not a great thing, and I think that it can actually work to strangle a network over time if things are not spread wide enough. And again, this is where we go back to needing a robust supply side to actually provide the utility in the first place, and then a demand side that can actually get access to the asset to consume the utility that the supply side provides. And if the asset is too concentrated, then there's not really an incentive to participate on the supply side, especially if you don't have a mathematically metered monetary policy that mints out over time. So I think networks that remain hyper-concentrated will slowly strangle themselves over time. Now, specific to the wallets, it's the problem is trickier than it appears, because you could have a wallet, for example, Coinbase's wallet, or they have a handful of wallets, right, that could actually represent holdings by 1 million people. And so this is kind of this age-old problem of how do we figure out how many users are actually holding the different assets. And to my knowledge, no one's really solved that problem yet. And so we just have to keep that in mind as the data is not quite as correct as it appears.
Actually, I wanted to speak to the question about hash rate versus price and how people are mining. I'm a miner, broker, trader. I do a lot of different disciplines, but on the trading side, back 2.5 years ago, I had to make a decision as to whether or not I was going to do speculative mining or if I was just going to mine for the day. And the only thing that's paid off is speculative mining, because I was running 75 S7s, and then you're like, okay, well, what do I do now? Because I'm running at a negative. At that point, you just really have to do the research and believe in one coin that it's actually going to pay off at some point. Bitcoin is going to do what it's going to do, but it's not what's up, when you're doing speculative mining. So, but my question is, that's just my personal take, and it's worked out quite well. So, so speculation wins over actual hash rate and price any day of the week.
What's the question?
So my question is currently to getting to most of the exchanges to do trading, swapping, whatever, the main gateway is still Bitcoin. When do y'all see that changing to open up to more currencies? I've seen just a few open up to Bitcoin Cash and like 1 or 2 that are doing Litecoin to as far as making your deposit. At this point, it's still almost impossible to use fiat to go directly into the exchange. Do y'all see that change anytime soon? Do y'all see a wave coming soon? Is it just that's how it is and that's how it's going to be?
Well, I think that we're already seeing that. You see Coinbase, Gemini already starting to list, exchanges that deal with fiat starting to list other things besides Bitcoin. And I think what slowed it down is once you're dealing with, say, US dollars or some other fiat currency, you're now under heavy government regulations, which is why many of these exchanges...
My apologies, Coinbase I don't count as a real exchange, so...
But you can get Ethereum Classic now, you can get Litecoin, you can get, what else, Bitcoin Cash on them now, so, and I think Gemini added, 0x is something they added, I think, and Gemini, I think you can now, they just added Litecoin, and they also have Zcash, so I think you're starting to see exchanges that deal in fiat start listing trading pairs with other
well, I guess my question wasn't really directed that way. I'm talking about the ones that don't, for instance, Cryptopia and some others that only allow deposits of Bitcoin.
This is not really a crypto economics question. Is it kind of? We have about 2 minutes left, so if you want to answer it quickly.
So I think there's a couple things to say here. One, I think Bitcoin pairs are going to be dominant for a very long time simply because it takes a lot of effort to build an exchange and to get trading volume, trading order flow. You sort of have to pick one underlying cryptocurrency, I think. And right now, no one can hold a candle to Bitcoin's liquidity. So until that changes, now what could change that? Well, there are many factors, but I think it would be very difficult for anyone to overtake Bitcoin as sort of the underlying. Does that answer your question? That's... Okay.
All right, we have to wrap it up now, you guys.
Really quick. The only other thing I'd add came up in the other panel, and that's the idea that because Bitcoin was the first crypto asset, every other crypto asset that has ever come to market is initially priced in Bitcoin, right? And this follows sort of the commodity theory of money of how something becomes a universal value. And it's a super intractable position to pull away because it's really composed of everything else choosing to price in that asset. And so I think that's why you're going to continue to see this. Maybe USD will try and compete. We've seen USD take share over time within some exchanges of trading volumes, but I agree with Chris that Bitcoin's the one to beat and maybe will not be beat.
Okay. Thank you very much, everybody. A big hand for our panelists. Thank you, guys.